Welcome back to Return My Capital. Today we're going to go over why passive investments like ETFs, index funds, even mutual funds are most likely far superior investment products for you than investing in individual companies, particularly if you have a multi-decade investing horizon. So, if you've got time on your side, you plan to dollar cost average your investments for years to come, or you want your money to work for you while you sleep, all those great thoughts. Well, if that's your approach, then why is individual stock picking likely to provide you with poor performance over, time? So, bottom line up front, the majority of companies will underperform the broad market over a long period of time. Basically, it's hard for a company to maintain its competitive edge and to continue to outperform decade after decade. And intuitively, this makes sense, right? Um, the product that you sell, the service you provide, the problem you solve, whatever it is, over time, consumer demands change, business demands change, yeah, company leadership grows old and moves on. There are so many factors that contribute to the fact that the best companies in the world today will likely not be the best companies in the world 30 years from now. So if you're 30 years old right now and you plan to retire at 60, well, loading up on Apple, Microsoft, Google, Amazon, Tesla, Nvidia right now probably seems like a no-brainer. Well, guess what? People your age 50 years ago thought the exact same thing about companies you've never heard of today. So you may be right, you might be wrong, but passive investing means you don't have to be right. You're guaranteed to participate in every new and exciting technology, every trend, every business process improvement and technical efficiency improvement for the next 50 years. So let's jump into some graphics and images to highlight these points. Let's see. We've got America's top companies in 1917 by sector, right? So steel, oil and gas, mining. This is World War I time frame. Food, telecom, even chemicals, autos, conglomerates, rubber, and textiles. Very different industries than you would appreciate on your day-to-day basis nowadays. A little bit of a different economy that we're living in now. If we look at just the top 50 companies, individual companies in 1917, you've got U.S. Steel, what is now AT&T, Standard Oil, a steel company, a couple of food companies I've never heard of, heavy equipment, DuPont, Nemours, which now you've got Dow, DuPont, Dow, and Corteva, I believe, is what that split up into in just the last couple of years. More steel, rubber, shipping, mining, you get the point. Very different industries 100 years ago, which probably is not a surprise. If we kick 50 years later, 1967, let's take a look at those sectors. Oil and gas, still the largest, but now you've got tech coming on. You've got telecom, film, autos, conglomerates, chemicals, retail showing up, medical showing up. If we look at the individual top 50 individual companies in 1967, this is where you've got IBM coming onto the scene as the top company. AT&T still hanging in there. Eastman Kodak. I think Kodak is still around, but certainly not the third largest company in the world anymore. General Motors, GM, you've still got Standard Oil, Texaco, Sears. I think they just went bankrupt, I think. General Electric, still hanging in there. Polaroid, oil. Dow DuPont Nemours. Xerox, more oil industry, right? A lot of oil. You've got Coca-Cola starting to come onto the scene. Procter & Gamble. Ford coming in here. What else do we have in 1967? Westinghouse. Oh, Dow Chemical. There you go. Chrysler. Caterpillar. That's kind of cool to see there. More steel, more oil. Let's see. Anything else that jumps out? Oh, Boeing coming in at 41 here. Goodyear, Gillette. General Foods, which became Kraft Heinz. Gillette acquired by Procter & Gamble. Some of these other companies acquired by, Bristol Myers, there you go. Bank of America, the first financial I've seen. Eli Lilly, that's interesting. Johnson & Johnson coming in. So let's go ahead and kick into 50 years later, 2017. Well, you see the dominance of tech in full swing here. Financial services, medical, conglomerates, telecom, oil and gas is now far in the rearview mirror. Food, retail, tobacco still hanging in there. So 2017, this is where you see what you would appreciate nowadays. You've got Apple, Alphabet, Microsoft, Amazon, little good old Berkshire Hathaway, Facebook, J&J, first oil company showing up, Exxon. Interesting to see that Exxon is ahead of Chevron pretty significantly in 2017. JP Morgan, Wells Fargo, Walmart, AT&T, Bank of America, Procter & Gamble, Visa showing up here, General Electric. I'm a little surprised to see it was still at the 16th largest in 2017, just 6 years ago. Oracle, Pfizer, Coca-Cola there. Let's see if there's any real big surprises. I'm surprised that Philip Morris was all the way up at 25. For those that are unfamiliar, that's the international. Philip Morris and Altria were the two big, or now are the two big tobacco companies. Philip Morris is the majority of the world, whereas Altria is the United States. Let's see, Disney. Okay, yeah, most of these should be no surprise to you. I am surprised to see in 2017 here Charter Communications and Priceline at 43 and 44 respectively. Schlumberger or Schlumberger, I don't know how to pronounce it, whichever is right. Here you see a chart looking at the 10 most valuable companies in the world from 97 to 2019. So I don't know if this is in terms of revenue or market cap and if it spans the entire 20-year period there. But you see some familiar names and maybe some that are new to you. We've got 10 biggest companies in 2019. Again, this should be no surprise. You've got your tech giants up here. You've got Alibaba and Tencent. I'm guessing those are quite a bit lower here in 2023 than they were 4 years ago. Largest U.S. companies, 2018 versus 2008. Here in 08, you've got Exxon, General Electric, Microsoft, AT&T, Procter & Gamble for the top 5. Well, 10 years later, let's see, the only one that's the same in there is Microsoft at number 3. 10 years later, you've got Apple, Google, Microsoft, Amazon, Facebook. You see Exxon fell from 1 to 9. General Electric is no longer in the picture. AT&T is no longer in the picture. Procter & Gamble is no longer in the top 10. So in just a period of 10 years, significant reshuffling. Biggest companies, market cap in 2011. Exxon was still the top one, but you had Apple coming up, PetroChina, BHP Group, so a couple of internationals. Sprinkled in. You've got Nestle, who was in the top 10. They certainly no longer are in terms of biggest company market cap globally. Got a couple other Chinese construction bank. Really, you can see how this changes so much over a short or a longer period of time. In 1970, top U.S. companies by revenue. GM was actually the top revenue company in 1970 in the U.S. Again, Exxon, but then Ford, General Electric, IBM, Mobil, Chrysler, Texaco. So a lot of steel still, a lot of oil. You even had CBS in there. Just not what you would be expecting today. And it's just further highlighting this point. If we look at that 50-year spread from 17 to 67 to 2017, you can see the stark differences. And this honestly does do a pretty good job of highlighting this with a pretty simple graphic here. Again, 1917, you've got AT&T, but everything else is chemical, steel, maybe a food processor, a lot of oil. 50 years later, you start to see the IBMs, the Kodaks, General Motors, Sears, and then again, 50 years after that, it's all tech, and then Berkshire Hathaway, big asset manager. This is a pretty cool chart. Largest companies globally by market cap, covering about 30 years here. So starting in 1980, you see IBM, AT&T, Exxon, a lot of the companies we've been talking about. 1990, this is a pretty interesting graphic. Pretty much all Japan, right? Japan had their big euphoric stock market run in the 90s where valuations of Japanese companies really got out of hand. And I think just recently, maybe in the last week or two, they finally broke even from the Japanese stock market, basically a value from the 1990s after their crash. We're talking 30 years of pretty much zero returns. Well, they finally, I think, are back in the green. But you see Nippon Telegraph and Telephone, Bank of Tokyo, Mitsubishi, Industrial Bank of Japan, Sumitomo Mitsui Banking, Toyota, Fuji Bank, Dai-ichi Kingyo Bank, IBM, UFJ Bank. 2000, right after the tech bubble here, Still got Microsoft, or maybe this was right. No, this was right. Probably during the tech crash. G's still in there. A company called NTT Docomo. Cisco, Walmart, Intel. 2010, PetroChina is at the top of the list. You've got ICBC, China Construction Bank, but you still got your Exxon, your Microsoft, your Walmart. And then 2018, no surprise, you've got the tech giants coming onto the scene, or fully in charge of the scene. You see some of the biggest companies globally in 94. A lot of the same names. You've got Coke in there, Merck, Procter and Gamble, even Johnson and Johnson in there. 95, you see some of the same. So I hope you enjoyed today's video. I just wanted this to be enjoyable and to have fun looking through the decades. I'm not saying there's not a place in your portfolio for individual stock picking. In fact, a very popular style of investing is to load up on these broad ETFs or index funds and then sprinkle in some of your highest conviction stock picks with the appropriate weighting for those, and it's called the barbell approach. So thanks again for tuning in. If you don't mind, like the video, subscribe to the channel, or don't, your call. Take care, and let's make some money.